Welcome to The Explainer. Today, we're going to dig into a market analysis that honestly looks past the kind of quiet headlines you're seeing everywhere. It uncovers some major risks that could be bubbling up for the US stock market. But, and this is the important part, it also shows how those exact risks could turn into some amazing buying opportunities.
All right, so here's what we're going to cover. First, we'll talk about the big headwinds the market's facing, including a pretty specific risk all the way from Japan. Then, and this is my favorite part, we're going to flip the script and talk about why a downturn can actually be a good thing. And finally, we'll zoom in on a couple of really interesting AI stocks you'll want to keep on your radar.
So the analysis kicks off with a point that's super simple, but also, absolutely crucial. No market just goes up in a straight line forever. It just doesn't happen. Even in these massive bull runs, pullbacks are totally natural. They're even healthy for the market. The key isn't to be scared of them, but just to be mentally ready when they show up.
Okay, so what could actually kick off a correction? I mean, what are the real triggers we should be watching? Well, right now, investors have their eyes on two big ones. Let's dig into the first factor, and for this one, we got to look all the way across the Pacific.
So, for years and years, Japan has basically been a huge source of capital flowing into U.S. assets. But there's a potential shift coming in their monetary policy that's got a lot of people worried, and it all boils down to this one thing called the yen carry trade.
So, what is the yen carry trade? Well, it's actually a pretty clever strategy. For years, interest rates in Japan have been practically zero. So imagine this, you're a big investor. You borrow a ton of Japanese yen for next to nothing, you swap it for US dollars, and then you invest that money in American stocks and bonds that pay way more. You get to pocket the difference. It's been a massive source of free-flowing cash for the markets.
Okay, but here's where the chain reaction could start. Japanese bond yields. They've just hit a 27-year high. That puts huge pressure on Japan to finally raise their interest rates. And if they do that, suddenly that whole carry trade isn't profitable anymore. In fact, it could unravel. Investors would have to rush to sell their U.S. stocks and bonds, buy back all that yen to pay off their loans, and all that selling could put some serious pressure right here on U.S. markets.
All right, that brings us to the second big risk, and this one might feel a little closer to home. We're talking about a potential cooldown in the absolutely red-hot AI sector, the main engine that's been driving this whole market rally.
And this slide, man, it really captures the tug of war happening in the market right now. On one side, you've got this incredible, massive, long-term hype around AI. But on the other side, we're starting to see a few cracks. We've seen some recent weakness from big software names like Oracle and CrowdStrike, and that sent a little shiver of concern through the whole sector, even pulling down some of the top dogs.
So, okay, we've got these risks looming. What do we do? Well, the key insight from this analysis isn't to freak out and run for the hills. Not at all. It's to totally reframe how you think about this. Stop seeing a potential downturn as some kind of crisis and start seeing it for what it is. A sale. A big discount on fantastic, high-quality companies.
And this quote right here, this gets to the absolute heart of the strategy. A market dip isn't a signal to panic sell. It's the opportunity you've been waiting for. It's your chance to buy into the future, but at a much better price. It's all about having your shopping list ready to go before the sale even starts.
Okay, so with that game plan in mind, the analysis gets really specific. It points out a few companies to have on your watch list. Let's take a look at 3 of them, and you'll see each one presents a totally different kind of opportunity if we do get that AI pullback.
First on the list is Oracle. Think of them as this legacy tech giant that's being pulled in 2 completely different directions. On one hand, they have this amazing, rock-solid core business, but on the other, they're carrying a really heavy financial load.
And right here, you can really see that conflict in action. Their database business, it's a fortress. I mean, they've got super sticky customers. We're talking governments, big banks, who can't just up and leave. That gives them a steady stream of cash. But their huge ambition to build out all these data centers for AI, that's being weighed down by a mountain of debt. They've even had trouble getting new financing recently. It's this internal tug of war that makes the stock so interesting and so volatile.
All right, next up, we're doing a complete 180. Let's talk about Micron. This is a stock that has been on an absolute tear. It's been doing so well that, honestly, the biggest challenge has just been finding a decent entry point. So, a market dip? That could be the exact chance everyone's been waiting for.
And if you're wondering why it's such a high flyer, just look at this. Their last earnings report wasn't just a beat, it was a complete blowout. They delivered earnings per share of $4.78, totally smashing Wall Street's expectation of $3.90. And this incredible performance is being fueled directly by the AI explosion.
So what's the engine driving all of that growth? It's all about this stuff right here. High bandwidth memory, or HBM. Just think of it as the super specialized, high-octane memory that is absolutely essential for training the most powerful AI models. Demand is just off the charts, which means Micron can command great prices, and it makes them a critical supplier in the entire AI ecosystem.
And last but definitely not least, the analysis looks at Google, and it makes a really bold claim. It calls Google the only true full-stack AI company out there today. And that gives them this incredibly powerful, defensible position that's just really hard for anyone else to copy. So what does full stack even mean? It means Google controls every single piece of the AI puzzle. They design their own custom chips, perfectly optimized for their AI. They build their own world-class models, like Gemini. And then they deploy all that AI across their gigantic suite of apps that billions of people use every day. That kind of vertical integration is a massive, long-term competitive advantage. It's their superpower.
But the whole analysis wraps up with a very real practical point. Look, it's great to have this shopping list of amazing companies you want to own, right? But for most of us, we don't have unlimited cash. And that's the real challenge, isn't it? Deciding where to point your limited resources when those opportunities finally pop up.
And that really leaves us with the final big question posed by this analysis. When the market inevitably gets choppy, and it will, what's going to guide your next move? Is it going to be the patience to wait for a great price on an amazing company? Or is it going to be that FOMO, that fear of missing out on the next big run-up? It's definitely something to think about.